Welcome to the Property Investing Roadmap Podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions, but then make a very quick decision, and they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build, and optimize your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
Real estate, fact or fiction? There's a lot of information out there, and we see it in the headlines, in the TVs, newspapers, these days TikTok, YouTube, everywhere you see comments about real estate and what's happening right across Australia. It's a popular topic, and there's so many facts and figures available which can be overwhelming, but there can be some useful information there as well. It's never been more accessible. I remember back in pre the internet, sadly, when I was around in real estate, you got it quarterly in the newspaper, and that told you what was going on in the market. But now we have figures that are out there, even sometimes daily, telling us what's supposedly happening in the property market. Now, today, to talk about sorting fact from fiction, we've got Robin Ram, who's Head of Research and Property Acquisitions at Momentum Wealth. Welcome, Robin. Now, you've been in real estate since you were a teenager. Tell me more.
That's right. I started at 18 looking like I was 14 in an industry where there was a lot of people much older than me. From day one, absolutely loved the industry. Did sales, did property management, even covered reception for a while, and just fell in love with the whole industry. That then grew to getting my own license to run my own business, and I started my own business at 21.
Oh, wow.
So that was quite an endeavour. Led to my buying my first property at 22. Not something that you typically buy as your first investment, or your first home actually. I think I got a $21,000 first home buyers grant benefit at the time. Bought a 2x1 duplex half. I asked my parents to buy the duplex half next door because it was sitting on a 6-unit development site. So I looked at that and going, not the best house, but really good opportunity for me. And that led on to multiple things through my career, to selling for 16 years, running my own agency, running an agency for someone else, working in a corporate real estate for one of the large franchise groups, became a trainer for about a 5-year period when I became a dad, so I could have a bit of a break from the weekend work, and very fortunate to be back in real estate again full-time for the last 2 years, running the buyers agency team and research team at Momentum Wealth.
Well, just an incredible amount of experience, Robin, and that was pretty impressive at such a young age. What was the passion? Why did you like real estate?
A bit of a mix. I love the variety. I love the people that you meet on the journey. I love the assistance you can give to someone to make an informed decision. And I like the ability we have as real estate people to influence an outcome for a client.
And obviously over that journey, you would have, on the buy side now, working at Momentum Wealth, and you've been on the other side of the transaction on the selling agent side. What do you like about the buy side versus what you did on the selling side?
A big winning for me in this role at Momentum Wealth is I've taken my focus from being a suburbs-based real estate agent to now a city and national property advisor. So I'm looking at factors beyond just the local drivers of one marketplace, looking at the whole regions, what underlines the growth for these regions, the performance, the desirabilities, the demographics, and how they change over time. Having a look at that has helped me both personally and professionally, and I'm now able to give clients much better guidance than I could have dreamed of as a suburbs-based real estate salesperson.
One of the things I've loved about being on the buyer's agency on the buyer side is you can actually tell a client, talking about fact from fiction, when you're a selling agent, right, you've got to promote what you've got, and that could be the ugly duckling or lipstick on a pig or whatever you want to call it. Whereas when you've got to promote that and say to people, this is a great property. But when you're on the buyer side, what I love about it is, and tell me if you feel the same way, when you're buying a property, you can filter out all the junk and all the rubbish and all the bad property investments, and you can really narrow it down and feel confident that when you're working for that client as the buyer, you're giving them the best available opportunities in their price bracket and what they're looking for.
Yeah, on a daily basis, I've really learnt this in the role, is you're defined by what you say no to. So every day we see what's hit the market on the different portals, what's on market, what's off market, and as a buyer's agent, it's really our job to say no to most of these opportunities and to limit the risks for our clients.
All right, let's get into the topic of fact from fiction, and particularly around the median price. Now, we said earlier on that this is one of the statistics that is most mentioned. There's a monthly reporting every month, and now there's multiple sources that report each month, not just one. It used to be, as I said earlier, quarterly. Then also, if you really want to dive into it, I sometimes do, because I'm a sucker for information. There's a daily index, so I can tell how each particular market's going even before it's reported at the end of the month. But what is the median price, Robin? Let's just dive into that and tell me what the median price is, and also then what are some of the pitfalls in using that in evaluating a market's performance?
The median price is a really good guideline for us, but where we find the biggest issues on people making decisions on a median price is how it's actually calculated. So it's important for people to realise the median price is effectively a list of all the sales that have happened in an area in the last 12 months. So the way I normally describe median price to a client is if there were 50 sales within a 12-month period, the median price would be number 25. That differs completely to the average price, where you divide all of those sales by the number of sales, which is the 50, and that's how you get an average price for a suburb. And the median average do differ significantly in a lot of areas.
Yeah, I've noticed that the particularly if you have a lot of high-end sales, a median, because the median sits in the middle, and it's not as influenced by one or two outliers at the top or one or two outliers at the bottom. But if you had a suburb where maybe the median was, for example, 800,000, but you had all of a sudden a couple of sales at 20, 30 mil, that would really skew the average, wouldn't it?
Completely, and that median all of a sudden increases way beyond what the rest are going for in the area. So that could be heavily weighted for the first few months of the year, it could be the last few months of the year, it could be spread out, it could be off-market sales in there could be related party transactions. Sometimes they group sites together and they sell for one premium price. So when you're looking at a median price point and you're looking at the middle point of all that data, it's not giving an accurate reflection of what's happening today. And if you're making a decision as an investor based on a median price point, you want as much up-to-date data as possible.
So if they're getting statistics, I gather all the reporting agencies and the groups out there. Just tell me about related party transactions. I guess you mean where mum or dad or someone has sold an asset to someone for $10, or for example. Is that what you mean by that?
Yeah, definitely. There's de facto and relationship breakdowns, married or de facto, where one party's buying out another one. Quite often in my selling days, I was asked to either price generously or conservatively or just be straight down the line. People are always trying to skew things in their favour. So determining what fair value is when one party's buying out another party is often quite hard. And if there's a separate agreement that's there, those prices can either over-reflect or under-reflect what prices are going for in the area. And
you've also commercial assets. Obviously, they're trying to gather statistics on what sales are, but sometimes, and I know when I look at I've got some commercial property investments, it's not always labelled correctly on those sites. So you're saying sometimes commercial properties could be lumped in as well?
They are. They're mislabelled, or the zonings don't align. So when they're looking at particular areas, so one of the areas I was operating, there was some particular zonings which allowed residential and commercial. So when you throw those sales in the mix and they're designed as residential, the medical and commercial per square meterage rate was much more attractive than the residential. So that can skew the data straight away.
One of the other ones I always find interesting is it doesn't actually reflect, does it, necessarily the underlying value and changes in all the prices. So if we get lots of high price sales, and we covered this in the book as well, if we get lots of high price sales in a particular period of time in a suburb, the median one in the middle could actually be quite a lot higher. That doesn't reflect necessarily what's happening fundamentally underlying in the market, does it?
That's right. There's a lot of markets right across Australia where there's a diverse range of properties for sale from, let's say, low 500, 600,000 right up to $5, $10, $15 million. So when you're grouping all those sales together and you're looking for the median, you're finding that data is going to be fundamentally skewed. So we've got a really good example for a suburb of Perth, which really
let's talk that through.
So there's a suburb of Perth called Mosman Park. It's western suburbs, very well located, close proximity to the beach. It's a very desirable pocket to live in, but it does have a diverse property range from one-bedroom apartments right to riverfront mansions.
Yeah.
So you could imagine with a sale price there, they would differ significantly. So when we unpacked it, and our research team had a good look at Mosman Park just to see what our results are compared to some of the major sources, and then putting our, market practice in there and removing the ones that we know are either third-party transactions or are skewed by being too high or too low from market prices. So we've had a look at them all. Over the 12 months to July 2024, there were approximately 250 properties sold in Mosman Park, ranging in price from $225,000 right up to $25 million.
Yeah, wow, it's a very diverse suburb.
Yeah, so Domain, as a data source, said the median price for that dwelling was $870,000.
Yeah, 870 was the one in the middle. And that's a big spread, isn't it? 225,000 right through to 25 mil. But go on.
Yeah, so then when you're looking at those sort of figures and you're seeing a sale that comes through or a couple sales coming through at a higher price range, Perth has been going through some significant price increases. And what we've seen is a lot of the lower end properties and the lower price point properties are selling. So the data is now being more skewed towards the lower end. So what we're seeing in 2023, 24 is we're seeing more cheaper properties selling within that suburb than the higher ended mansions. There's also less higher end properties in that suburb than the volume of properties priced below 1 million.
Yeah.
And these are the ones that are selling. So you're looking at the percentage change for 1 year for a very desirable pocket of Perth called Mosman Park, and you're seeing REWA report a drop of 26.3%.
In one quarter, wow.
And when we did our own fine tooth comb over the same data, we found it was about 20%.
It's quite a difference, isn't it?
Yeah.
You know, it's funny you mentioned that suburb because I did own a property in that suburb and when I was in my 20s. And this is what really struck me about why the median price is, as reported, is not actually that accurate. And I'll tell you my example on it. So in that suburb, for the listeners who don't know, it's a waterside suburb in Perth. And on one side you've got the river and it's bordering North Fremantle, and the other side it's bordering Peppermint Grove, and the back end is bordering Cottesloe. So it's in that that affluent area of Perth, but as you mentioned, it's quite a diverse suburb with lots of different properties, from one bedders right through to mansions on the water. So when I bought my home, about this is when the quarterly analysis used to be out there, and then about 9 months later, there was a lot of there was a new development where there used to be some industrial land on the waterfront down there, and a lot of those houses had been finished and started to sell. And there was me sitting in this house and thinking, it's probably gone up about 8% this year. And the median price, because of all the high-end sales that were happening in this new waterfront part of the area that had been converted from an industrial area, it said 36%. And then I talked to my neighbours, and everyone was talking about, we're up 36%. And they weren't. They were up 8 to 10%. I had to start explaining. So that really made me delve into the median price and how it can be really distorted. But I would suggest that many people still take it as gospel that when you say the median price is up 30% or 20% or whatever that number is, that they think their property's gone up exactly that amount, don't they?
Yeah, and like you said, I had a very similar example in my selling days where one of the Perth marketplaces I was in recorded a price growth of 43% in 1 quarter. So all that happened in that particular quarter was large development sites sold. When those development sites were off the market, had sold, there were no more available. It went back to the normal prices for areas, which were 3-bedroom, 2-bathroom villas and 3x1 homes in the area. So all of a sudden, we see 43% price growth. All these people are calling me up for an appraisal, wanting to sell, saying, look how well the property market's gone. And I've had to explain to each and every one of them that the data was really skewed by those high-end development sites that are sold in that area. And we'll see a return to normality, the following quarter.
So let's delve into some other reasons why we can't always rely on the median price, and we're going to discuss pitfalls from Chapter 8 that's covered in the book. And let's first cover off the age of the homes. How does that impact the changes in median price?
The age, and as you said, your book explains this very well, and if you don't mind, I'm going to use your example.
Sure.
It's just very pertinent. So if you're looking, and let's say you pick, which you did, a $440,000 property in a newer suburb, let's say the house is around 4 years old each, and you compare that to suburb B, property B, where the house is around 30 years old. So you're buying something in a newer suburb. The newer suburbs in Perth, at least, family-sized blocks are now 375 square metres. So that's what they're calling family-sized blocks. The ones that we're normally buying are 600, 700, 800 square metres on behalf of clients.
Yeah, that's quite a difference, isn't it? But that's just the historical nature. Land used to be, back in the old days, quarter acre, 800 metres, 700 metres, and they keep going down, don't they? So now they're about 375 square metres.
For a family-sized lot.
Yep.
So you're buying one of these family-sized lots, you buy it for $200,000, you put a $240,000 house on it, you've got it worth about $440,000. Or what you do is you buy an investment property in an area B, where you've got a $440,000 purchase. It's a 3x1 potentially on 700-800 square metres of land. You've got about $320,000 worth of land value, and that building is depreciated over those 30 years to about $120,000 in value. So yeah, when you're in your book, you described it really well, that if we see a marketplace go up 10% in the land values, you're seeing that 375 square metre block of land going up 10%, and you're seeing the 600-700 square metre block of land going up 10% as well. But you're getting, let's say, 600 square meters going up 10% versus that 375. You're also seeing the buildings depreciate. So if you take a 3% depreciation rate over that year, let's say you take off the depreciation for both properties and then you sell 1 year later, 1 year later with a 10% increase could see the newer suburb at about 428,000. The land's gone up 10%, 200 to 220, and that building has depreciated from 240,000 to 232,800. If you would have bought investment property B, which is the older house on the bigger block, the land value would have gone up $352,000, up from 320, and the house would have depreciated from 120,000 to about 116,000. So the capital growth difference for both properties is completely different.
Yeah, and that's it. So if you've got a lot of newer homes in a suburb, that could impact over the long run the median price. Doesn't mean that an older house in that particular suburb on a bigger block might not have just performed as well, and that's really critical. And we'll cover in other episodes about the land value and how important that is. But also importantly, I find is the renovations, because the median price is just simply a number what they sell for, and they don't factor in, do they, what people spend on renovations. And often you find in more affluent areas in particular, or in becoming more affluent, people will buy a house, particularly if the houses are 20, 30, 40, 50 years old, they'll renovate it, and just explain through that how that would impact then the median price.
Yeah, I've got a perfect example of recently helping a client. This client purchased in the northern suburbs. They purchased of Western Australia. They purchased a property around $730,000 as an off-market purchase. The property was actually on the market with an agent. They received an offer. The offer fell through on finance. They reached straight out to us and said, look, would you guys have anyone? We need a quick sale. We looked at the property. The tenant had been there for 9 years. The house had had pretty much no money spent on it by that investor for about 20 years. So walking through the property, most buyers would have been put off by this house and would have seen it and go, nope, too much work, not interested, see you later. The same time, a fully renovated 3x1 property had just sold for $890,000. So our investor picked up a property for $730,000, which is going through renovations at the moment. Those renovations are going to cost about $60,000. When that's done, they're going to see a 12.33% increase in value within such a short period of time based on what a fully renovated property would sell for.
Yeah, but it's interesting, isn't it? Then on that basis, let's say everybody in that suburb paid $730,000, just as a simple example, spent that money in renovations and all sold for $890,000. It looks like the median price has gone up $160,000, when in reality it hasn't. It's gone up a lot less because they've all spent money in renovation. So that's not real growth. That's the value add that they've done to those properties, isn't it?
That's right. So this one getting a 12.33% increase within 1 quarter compared to the Perth average for this quarter is 1.6%.
Yeah.
We're seeing a significant difference there. So if, like you said, if everyone starts renovating these properties and the media reports all of a sudden a huge price growth in an area, that's not a real reflection of the underlying land value that's gone up.
Yeah, and that's the thing I certainly noticed over time is while the premium areas often do perform particularly well, and because they're in good locations and the people want to live there and all those things, I have found over time when I look at it, when you go fundamentally into it, that not everybody of course is renovating, but a lot of people are spending money on their properties, and it might not be full renovations, might be smaller renovations. And then, of course, the sales prices are going up because of that. That is not necessarily a true reflection. So those suburbs don't necessarily always outperform. It's because people are spending money on their properties and it's getting imputed into the value, isn't it?
That's right. And then the more lovely a house is, sexy sells. So when it's a lovely house, people are overpaying for these properties compared to something that doesn't look as good but still has the right bones and the potential. Those ones that are just someone's fallen in love with it, overpaid just to secure it, those ones skew the data too.
Let's talk about how do we get a more reliable reading or understanding of a median house price figures. So what are some of the things we can do?
I think we need to look at what's happening across the range in the areas that someone's looking at. So having a look at the portals are quite often a good way to do it. See what properties are selling for in the last 6 months. They quite often have 6 months worth of data. So you can look back and see inside these houses which ones were renovated, which ones weren't, what the sale prices achieved. And that can give you a good benchmark for what's happening. I think it's important to speak to local agents as well in an area to see who's driving this demand. There are certain pockets within suburbs and capital cities that are very investor focused at the moment. So that large investor activity is pushing up prices very quickly. As soon as those investors leave those particular suburbs, those prices can very quickly come back if too many of your sales are coming from one portion of the market.
So with so much coverage and information out there, reporters and real estate experts, it's easy very much, I think, for misunderstanding to creep in. What are the go-to sources that you use for credible and reliable market about real estate?
We're looking at not only how something's performed over the last 3 months, we're looking 3 months, 1 year, 5 years, 10 years, 20 years and 30 years. So we're averaging out how a marketplace has performed over that period of time. We're looking at multiple data sources. We're looking at things like CoreLogic. We're looking at PropTrack. We're looking at SQM, DSR data, REWA data, and whatever data we find that is relevant to the marketplace that we're operating in. And being quite fortunate to be the position we're in where we're both managing and buying properties within a marketplace, we've got really good up-to-date data as how many people are in these home opens, who are we competing against, how many offers are going in, and that can really determine what we feel is a good opportunity for our clients.
So let's cover off some of the mistakes that people make when they're looking and utilising this data. And I think one of the first ones I want to talk to you about is because people go, well, this is a hot suburb, I'm going to, or hot market, hot area, I'm going to invest there. But how important is it for them to then be thinking about their own unique circumstances, not just what's the latest hot suburb?
It's huge. A lot of people are just looking at that. And the questions that we do get from people who ring up and say, look, where should I be buying? What suburb should I be buying in? Those suburbs can change quite significantly. Those suburbs, like I just mentioned earlier, the ones that are heavily focused on investor demand will often come back the quickest once those investors stop purchasing within those suburbs. So it's understanding who's in there and also who your market's going to be when you're selling that property. So when you begin your investment and your property purchase with the end in mind, it can really help make your decision on the underlying factors, not the emotional factors or the headline factors that might be relevant today and then in 3 months be irrelevant again. So historical figures quite often is a big issue. People following what the media's got to say, unfortunately sometimes following what family members or friends have got to say who call themselves experts because they've maybe purchased one or two in the past and they do have a position of influence over their family members or friends. So it's balancing out what someone's best intentions are for you with real data that can say, yes, well, this is why.
I think that's just one of the important points here. Is just because a suburb has been a high performer for the last 10 years, for example, it doesn't mean it's going to be in the future. It might have run its race. It might have been, re-rated, revalued. And we've all seen that in all the capital cities, Sydney, Melbourne, Brisbane, Perth, Adelaide, where a suburb is closer to a one that seems a bit more affluent, a bit more popular. It gets re-rated, but that doesn't necessarily mean it's going to be the best suburb for the next 10 years, does it?
Yeah, and it doesn't mean it's going to be the right investment or property for that particular person too. And that's where taking their own goals into consideration is hugely important. I hear pretty much every week from an investor like, isn't that house too nice to purchase? And I think that's a huge mistake that people often make, that they think they're going to buy an investment property. They want something that's really original, maybe a little bit run down, something that no one's going to trash, yet they still expect the best quality tenants in this property. So if you can find something that meets your objectives and go, what type of property can I buy that I'm going to hold on to for the longest so I can get the best growth out of it, that is crucial. I would much prefer an investor buy something that is slightly newer with less maintenance if they don't have the money to spend, a bit better yield than buying something on a bigger block, older, more run down. They get frustrated with the property because of the maintenance costs that might be there for a 1970s house, and all of a sudden they sell something after 3 years and don't realize the true potential of their investment. And quite often these people then turn away from real estate and going, oh, that didn't work. Well, it didn't work because you bought the wrong style of asset for your particular needs.
So ultimately, with all this information out there, it can get a bit overwhelming, can't it? How important do you think it is then for an investor, if you're doing it yourself, to get out on the ground or alternatively using a buyer's agent? How important is that on-the-ground information, going to the home opens, getting the shoe leather worn out and going from property to property? How important is that, whether you're doing it yourself or a buyer's agent, compared to just looking at data?
Nothing beats real-time experience. Going out to home opens in multiple suburbs will really see how many buyers you're competing against, what are the types of buyers purchasing in this area. So, for example, recently went to a home open where there were probably 60, 70 groups through this particular property. full of people looking for a family home. I went to another one where it was an investor-focused suburb, and I saw a lot of investors there stacking up the rental viability for this property compared to home ownership. So looking at, okay, well, Suburb A, for example, the first one that I went to, is still going to be quite popular because this is an area people are wanting to live in right now. They're probably going to want to live there again in 3 years, 5 years, 10 years. So looking at different areas, looking at different trends, looking at the livability within these suburbs. And then when you get an idea of values and what properties are selling for, when you see something priced quite well, you actually can make an informed decision to go, this is a good opportunity and we should go for it, compared to only looking at a handful of properties and then just going, yeah, I'll just pay and I'll pay whatever the agent or the asking price is just to secure an asset, when that might not be the best asset for you at that price.
So, Robin, what would be your top advice for anyone looking to buy an investment property or a home and utilising data? What would your top tip be?
I would always say begin with the end in mind. Look at what you're trying to achieve as an end result from this house or from this investment property. Work to a plan. So decide that plan before you start going out to home open so you can buy the right style of property that you're comfortable to hold for the long term. I would then say take your time. I see too many people in general make rushed decisions that they regret later. There'll always be new properties coming onto the market, regardless of where you are and how competitive it is. It's not as generally some people are do or die. I have to have this one. I have to pay whatever it takes to get it. Take your time with the property. There are more properties coming up next week. And last one would be learn as much as you can. Read information, go to home opens, just talk to agents and just get as much information as you can, and that will guide you hugely.
Well, there was lots of great tips there, Robin, and I did ask for one, but you gave us plenty, which is fantastic. Now, I want to leave you with a final bit of advice, and we've talked a lot about where you can go wrong with property data. It's also important to acknowledge that data is an incredibly powerful tool, and one we're lucky to have so much access to so much information. It can be confusing. You just need to know when to use it, how to use it, but importantly, always remember, you've still got to get out there on the ground, go to the home opens, talk to the agents. That's how you get a full picture of what's happening out there in real estate. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest.